$200 silver dream is slipping. Here's what smart investors are doing instead. Everyone is talking about silver. Every chart looks unstoppable. Every forecast sounds certain. But markets are most dangerous when certainty feels comfortable. What if the $200 prediction is not a signal of strength, but a sign that expectations have run too far, too fast? Because when everyone agrees on the same outcome, risk doesn't disappear. It quietly builds beneath the surface. And what disciplined investors are doing right now looks nothing like the excitement playing out online. They had seen this before, not just in silver, but in many markets over time. Prices rise sharply, confidence spreads, and doubt slowly vanishes. What replaces it is agreement. And agreement in markets often signals vulnerability. Silver's rise had been dramatic. Long-standing resistance levels were broken. Targets that once felt unrealistic were quickly accepted as reasonable. Analysts adjusted their views. Media coverage turned positive. Public interest surged. To many, this looked like confirmation that the trend was only beginning. To experienced observers, it looked different. Markets rarely become safer when everyone believes the same story. When skepticism disappears, positioning becomes crowded. Buyers rush in at higher prices, while sellers step back. The balance weakens. Small changes in conditions can have large effects. Price alone did not explain risk. A rising price can hide growing fragility. As silver climbed, fewer investors asked whether it was fairly valued. Most focused only on how much higher it could go. That shift mattered. They noticed who was arriving late. Retail investors who ignored silver at lower levels now felt urgency. The fear of missing out replaced patience. History showed that this emotional phase often appears near important turning points, not at the start of long trends. This did not mean silver's long-term potential had ended. It meant the short-term structure had changed. Risk and reward were no longer balanced the same way. Late buyers were taking on far more uncertainty than early participants ever did. Consensus feels reassuring, but it rarely protects capital. In many past cycles, near-universal optimism marked moments of transition. Markets need disagreement to stay stable. When disagreement fades, instability grows. Smart investors recognize this shift. They did not panic. They did not chase. They slowed down. They reviewed structure, valuation, and positioning. They understood that strong trends often pause, correct, or disappoint before continuing. This was not fear. It was discipline. And discipline, more than excitement, has always been the difference between speculation and strategy. Have you seen the price of silver lately? It's been on an incredible run, and a lot of people are dreaming of it hitting $200. But before you jump in, let's talk about what some of the most serious investors are looking at right now. They're not just looking at the price. Many market participants ignored valuation because it did not fit the dominant narrative. The narrative was simple and appealing. Supply was tight. Demand was growing. Therefore, prices must continue higher. But narratives compress complexity. Valuation restores it. They understood that price targets often reflect momentum, not mathematics. When analysts projected $200 silver, they extended recent trends forward in straight lines. They assumed conditions would remain unchanged. History rarely supports that assumption. Valuation does not predict exact timing. It defines probability. When an asset becomes expensive relative to its fundamentals, the probability of disappointment increases. Not certainty, probability. Smart investors respected that distinction. They did not try to call the top. They adjusted exposure. They reduced urgency. They waited for the market to offer better terms. The most dangerous belief in any cycle is that price has replaced value. When that belief takes hold, discipline fades. Risk appears invisible. But value always reasserts itself, either through time, correction, or both. Silver had not escaped that rule. It was simply testing how far belief could stretch before reality pushed back. This was the quiet tension beneath the headlines. The $200 silver dream is slipping. Here's what smart investors are doing. Instead, they noticed that nearly every bullish argument led back to the same claim. Silver was scarce, supply was tight, there simply was not enough metal to meet demand. At first glance, the logic sounded convincing. Prices had risen sharply, inventories felt strained, and delivery delays were widely discussed. But experienced investors asked a different question. Why was supply tight, and would it remain that way? Silver is not produced like most commodities. It is rarely mined on its own. Most of it comes as a byproduct of copper, lead, and zinc mining. This structure creates delays. When prices rise suddenly, production cannot respond immediately. That delay often fuels sharp rallies. But delay is not permanence. High prices change behavior. As silver climbed, incentives quietly shifted. Scrap metal that once sat unused became valuable. Old jewelry was sold. Industrial waste was recycled. Materials that were not worth processing at lower prices suddenly entered the supply chain. This did not make headlines, but it altered balance. Mining economics changed as well. Projects that were unprofitable at lower prices became viable. Companies revisited stalled developments, exploration budgets expanded, expansion plans accelerated. These responses did not happen overnight, but they followed a predictable pattern seen in every commodity cycle. Scarcity narratives tend to peak when prices are highest. At those moments, shortages feel permanent because recent memory dominates thinking. Yet markets are adaptive systems. They respond to incentives, not stories. They also understood that tight supply does not guarantee rising prices forever. It only explains why prices rose in the first place. Once the supply begins to loosen, even slightly, extreme valuations lose their foundation. Markets do not need oversupply to fall. They only need less scarcity than expected. Physical market stress was often misinterpreted. Elevated premiums and delivery delays were treated as proof of a broken system. In reality, they reflected short-term congestion driven by speculative demand. When demand cools or supply increases, those pressures ease. Basic economics remained intact. High prices encourage supply and discourage marginal demand. That process is slow, but it is relentless. It has ended many rallies that once felt unstoppable. Smart investors did not deny silver's industrial importance. They acknowledged strong long-term demand. But they also recognize that short-term price extremes often rest on fragile assumptions about supply staying frozen. When those assumptions weaken, markets adjust. The illusion of permanent scarcity fades quietly, and when it does, prices no longer need dramatic news to change direction. They simply follow the incentives already in motion. That was the risk few were discussing while the headlines stayed bullish. The $200 silver dream is slipping. Here is what smart investors are doing. Instead, they did not need to imagine how this story might end. History had already written several versions of it. Markets had seen similar moments before. When prices rose quickly, confidence became widespread, and expectations grew detached from structure. In past cycles, silver and other commodities followed a familiar path. Strong rallies attracted attention. Attention attracted speculation. Speculation pushed prices beyond levels supported by fundamentals. Then, without warning, momentum slowed. Prices did not collapse immediately. They stalled, corrected, or moved sideways long enough to reset expectations. They remembered 2011 clearly. Silver surged to historic highs, driven by fear, enthusiasm, and leverage. At the peak, the dominant belief was that prices could only go higher. When the correction came, it was not gentle. It was fast and unforgiving, especially for those who entered late. They also studied gold's earlier cycles. Even during powerful long-term bull markets, sharp corrections were common. Those pullbacks were not failures. They were necessary pauses that removed excess and rebuilt stability. Investors who waited were often rewarded with better entry points and lower risk. Positioning mattered more than predictions. Futures data showed that speculative traders were heavily committed to the upside. At the same time, commercial participants, miners, and industrial users were increasingly hedged. Historically, that imbalance signaled caution. The participants closest to the metal were reducing exposure, while financial players were increasing it. They watched the gold-to-silver ratio closely. In healthy silver bull markets, silver tends to outperform gold. When that relationship weakens, it often signals that speculative enthusiasm is fading. Subtle shifts in relative performance can reveal more than bold headlines. Smart investors focused on probabilities, not promises. They asked whether buying at elevated prices offered favorable outcomes. They considered alternatives, holding existing positions without adding, waiting for corrections, preserving capital for moments when risk was lower and value clearer. Waiting required discipline. It felt uncomfortable when prices were high and optimism loud, but discipline had always been the quiet advantage of long-term success. Markets reward patience far more consistently than excitement. They understood that silver's long-term case did not depend on chasing extremes. It depended on timing, structure, and risk control. Missing part of a move was not failure. Losing capital to impatience was. This was not a call to abandon silver, it was a call to respect cycles. The dream of $200 silver might not be gone, but the path toward it was unlikely to be straight. And those who recognized that early were not pessimists. They were prepared.